Today we're going to cover life insurance. As you can see on the slide here, the primary purpose of life insurance is to protect someone who depends on you for income, and they would have a financial loss if you died. All right? So life insurance is not set up so that if you die, your sister gets to go buy a really cool car, or someone else hits the lotto because you're dead and they get hundreds of thousands of dollars to go do whatever they want with. That's not the concept of life insurance. It's supposed to replace that income and keep your loved ones in the same financial situation as if you were still alive. Okay? So how do we get life insurance? Well, first you buy life insurance just like you would automobile insurance through a policy. There'll be lots of insurance companies that are going to offer that with all different kinds of rates. And what you'll do is you'll pay a premium, and if you die, they will pay off a specific amount of money. $200,000, $500,000, $1 million, whatever that dollar amount is. Typically, policies beneath $500,000, there's not necessarily a lot of due diligence. Maybe they do a blood test, someone comes out and checks your weight and something like that, but not necessarily a lot. Once you cross $500,000, $750,000, $1 million insurance policy, then carriers tend to get a lot more due diligence. They'll have you go to a doctor's visit. They'll do a treadmill. They'll do an EKG. They'll do a lot of other advanced testing to try to figure out what are the odds of you dying, so they have to pay out that $1 million. And when they figure out the odds of you dying, they'll then use that as a premium. The more likely you are to die, the higher your insurance premium is. Right? Just like an automobile. The more likely you are to get in a car accident, the higher your premium. So how do they track it for auto insurance? Your number of tickets, number of accidents, and age. And what that'll do is it'll give a pretty good representation of your odds of getting into a car accident. The same with life insurance. It's going to look at your cholesterol level, your weight, your BMI. They're going to maybe do an EKG, and they're going to look at your age, and they're going to put all that together and come up with a likelihood you are to die. The more likely you are to die, the more expensive your premium is going to be. So, what are we going to use this life insurance for, or what's the purpose? Well, certainly we might want to get our mortgage paid off and our other debts paid off. So if I passed away right now and my family lost the income, would they be able to make their mortgage payment? Maybe they can, maybe they can't. So therefore, I need life insurance to pay off that mortgage. Maybe we want to also leave our kids some lump sum endowment for some reason. Maybe we want to leave each of them $100,000 to be able to buy a house. And I think that, my kids are young, but by the time they got to the age to get a house, I would be able to help them with the house. But if I'm dead, obviously I can't help them, so I might want to set that up. We might also want to set up a fund for education. And we see that a lot with life insurance, where a significant amount of money, $50,000, $200,000, $400,000, goes into an educational fund for the kids. And the kids can access that money for books, tuition, and other college-related expenses, tutoring, etc., etc. But if they don't have any education expenses, they are unable to access that fund. We also might want to leave some of the money to a charitable institution, whether that's a specific college, a cat rescue, a dog rescue, your church, whatever that might be. Some of the other things that we use life insurance for is to provide retirement income. I think mostly that's a bad idea. You should be buying term insurance and not an insurance policy, a life insurance policy, that also has an investment component to it. 99.9% of the time, term life insurance is going to be by far the best way to go versus whole life or universal life that includes in it an investment portion. And we'll get back to why that is. All right? Also, I might want to set this up so that when I die, I have life insurance that are going to pay my estate and gift taxes. These are all over the place in the past 10 years. Estate taxes have been as low as 0, as high as 40% on everything that you have. We've had exemptions of $600,000, $1 million, $5 million, but Congress keeps playing with this number, and so it's really a hard number to track at this time. But a lot of people will set these things up because if someone dies with a large value of a business or something like that, if we looked at the owner of the San Diego Chargers, the football team, when he died, he basically left a team that was worth about $200 million. And he owed 40% estate taxes on that. So he owed $80 million on the $200 million sports team, which basically meant the asset to come up with that money, the family had to sell the team. And sometimes families have to sell businesses just to pay the estate taxes. Congress is trying to play with that an awful lot. We could argue why that's a good thing, why it's a bad thing, redistribution of income, or these individuals made the money, invested, did well, why should they have to pay taxes again on what they've already paid taxes? But certainly a lot of arguments about that, both sides, but we just want to basically keep on top of that. All right. So we talked about this a little bit before. The insurance companies will actually end up with mortality tables. In other words, they're going to figure out the odds you're going to die. And if they've come up with the fact that there's a 1% chance for you to die this year, and you want a $100,000 policy, then their loss, expected loss, is going to be 1% of 100,000, which means they need to have charged you $1,000 that year just for the expected loss. And then on top of that $1,000, they got a commission for the agent, they got their overhead, they got profits, and so you'll probably end up getting charged maybe $1,400, $1,500 for that policy. All right? So do you need life insurance? This is one thing that a lot of people wonder. Do I need life insurance? Does everybody need life insurance? And everybody does not need life insurance. So first off, we need to protect family members who need us financially. If someone does not need us financially, then we do not need to have life insurance for them. So like my sister, my mom and dad are independent. They're not using any of my money. So I don't need to buy life insurance to give them money. Also, I don't need to have life insurance on my kids. Because as horrible as this sounds, right, knock on wood, if my children were to pass away, I would be in a better financial position because I'm not going to have to pay their college education. I'm not going to be buying them cars. I'm not going to be getting them down payments on houses. I don't have to feed them, and 2 teenagers are an awful lot of food that comes through there. A lot of Hot Pockets and whatever else that they're going to eat. And so I'm not going to have those expenses. So while a lot of people insure their kids, and they talk about that they need it for burial expenses and etc., odds are you're going to be saving so much money, burial expenses aren't going to be that much. Yeah, maybe $10,000, $20,000, $30,000, but that's probably half of what I think I'm going to spend on my kids in college expenses. So while that certainly is a morbid type of thought, it's just financially you do not need to insure kids. Unless you're dependent upon those kids' income. If your child is a childhood prodigy, a star in the movies or as a TV sitcom, and you're being paid $100,000 a year as the manager, then you are dependent upon the income of your child, so it makes sense to insure your child in that situation. All right, so what are some other situations? If you're single and you have a lot of debt, you might want to have life insurance because morally, I think it's the correct thing to pay off your debts. Now, if someone dies, your brother, sister, mom, and dad, and they have lots of debt associated with their estate, you are not responsible for their debt. You do not have to pay the debt of your brother or your mom and dad. Now, that debt will attach to the estate. And so if your parents have $200,000 in debt and they have a $500,000 house, then that $200,000 will end up attaching to the house. But if they don't have a house and no other assets, and all they have is $200,000 in debt, and all their assets are a bunch of old furniture worth $500-600, you do not have to pay the $200,000 in debt of your sister or parents, right? But one of the things when we look at parents, are your parents dependent upon you? Maybe they didn't save very well. Maybe they've had setbacks in health care or something like that that ate up most of their retirement fund. But you know that you're going to start kicking in for them, or you're already kicking in for them. Then you want to set some money aside for your parents to help them. All right? All right, so how do we estimate how much we need? Well, there's lots of different formulas that we can come up with. Formulas are great because they give us a very simple answer to complex questions. But certainly if we come up with a very simple answer to a complex question, it could be way off. And that is very common. Some of the ones that they use are what's called the easy method here, 70% of your salary for 7 years while your family adjusts. I think that's an okay method if you're married and you're both young and you both have about the same income level, and this basically is going to help the other person make payments, keep the car payments going, maybe got some Visa debt, whatever it is. That makes sense, especially if your spouse is going to remarry. So you might be 23 years old, 25, 27, you don't have any kids, you're married to the love of your life, but in all realities, if one of you passes away, the odds of a person going from 25 to 75 without remarrying is probably really small. So odds are they're going to get remarried. The other method, the DINK method, which basically says, hey, you're both working, everything's going. What we're going to do here is we're just going to pay for funeral costs plus half of whatever debt's out there because our dual earners make about the same amount of money. All right, the non-working spouse method. Okay, what this says is I have a non-working spouse. It also assumes that once the kids reach 18, 19, your spouse is going to go back to work, and then they'll be able to support themselves. And so we look at $10,000 a year until your youngest hits 18. That is a very, very small number, especially here in Southern California. So maybe we're looking at $10,000 per kid until they turn 18. Maybe we're looking at $50,000 or $60,000 a year to support the family, right? Depends on their situation. And this comes up to a conversation that you really need to have with your spouse. And that is, what are you going to do if your spouse is dead? A tough conversation to have, but like I had with my wife. And we looked at our house and said, if I die in a car accident, are you going to keep this house? If not, where are you going to move? And where you move to, is it going to be more expensive or less expensive? So one of the conversations we had that if I died, my wife would move out of the house because she doesn't want to maintain the big house, and she'd probably move into a 3-bedroom condo with the kids. And so we actually looked around and said, okay, how much do those cost? How much would it cost to move? And then say, would the sale of this house cover that or not? And in our situation, it would. And so we made sure that there was that adjustment that could be made and how much it was going to cost. All right? And so that gets us basically to the family need method, which is basically going deeper into things like that. Will you stay in the same house? What are the health care requirements of our kids? Do we have kids that are sick? Do we have a kid who is just a phenomenal athlete and they're in gymnastics, and they're going to keep doing gymnastics, and gymnastics can end up costing $1,000, $1,500 a month. If one of us dies, are we going to pull them out of gymnastics, or do we want them to stay in that sport? So, like, my son was an incredibly accomplished gymnast, and it probably cost us about $2,000 a month to keep him in that. So if I died, do I want to keep funding that, or are we going to cut that out? Those are the type of things you need to talk about. Okay, so I'm going to expand a little bit on this family need method. Basically, I think everybody needs to look at their life insurance this way, because there's a lot of unique things that go along in everybody's life and relationship. So here on this axis here, we have the amount of insurance we're going to be buying, and down along the axis here, we have our age. All right? So typically when you're born, you need 0 life insurance. Basically, you're not providing money to anybody. You're basically a net taker for 18, 20, 25 years as you're being supported. And so, once again, as horrible as it is to say, if a child passes away at the year of 1, their family's in a much, much better financial situation than having to support them for the next 18, 19, 20 years. Certainly it's a tragedy. We don't want that to happen, but when we're dealing with finances, that's a reality. So typically between the ages of, say, 0 and 20, 25, your need for life insurance is pretty much 0. Then you get married, and you buy a house, and you know that your spouse cannot afford this house on their own. So at the age 25, maybe we're going to have $200,000 in life insurance to pay off the mortgage, and our spouse is working so they can pay their food, they can pay utilities, but they would really struggle making the payments. So we're going to get a couple $100,000 of life insurance. And that runs just fine, and then all of a sudden we have our first child. Now you have to support that child for 20 years. The other spouse probably isn't going to be able to work nearly as much if you're passed away and they're a single mom or a single dad. So they're going to see less promotions, less overtime. And so all of a sudden, to fund all that, we might need another $300,000. And then we go along for a little while, and then we have our second kid, in which we got to support them for 20 years or so, plus their college and everything. So then it jumps up again. And we have our third child, and it jumps up again. And so for me, the time that I actually had the greatest need for life insurance was when my wife told me that because it's always we're pregnant now. The wife's never pregnant, it's we're pregnant, right? That's the politically correct thing to say. So for all you guys out there, it's we're pregnant. Okay, so when I found out we were pregnant with our third child, because my wife was going to stay home with the kids, incredibly expensive. I've got 3 colleges to pay for, cars, insurance, etc. So we had a ton of need. And then we decided that's enough kids to have, right? And so then every single day that goes by, I need less and less life insurance. The reason I need less and less is as we're creeping towards them getting 18, 19, I have less and less financial responsibility. And so my financial responsibility is going to go down, 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 down. Then they're through college and everything else. Now I get here maybe to the age of 60, right? I no longer need maybe $2 million of insurance. Maybe now what I'm looking at is I'm the age 60. My wife's not working. Maybe she's staying at home. Maybe your spouse is disabled. There's, still got a mortgage maybe. A lot of different things going on. I no longer have to pay for my kids. They're done. They're through school. They're in their house. They've got their cars. Their lives are fine. They are not dependent upon me anymore. I don't need life insurance for them. I don't need to pay for it, right? So maybe at this point, until I hit retirement, and have my full pension, maybe I just need $300,000 to pay the house off. Then I get to age 65, I retire, I tie my pension to my surviving spouse, so my spouse is getting Social Security. If I pass away, she'll get part of my Social Security, plus my pension. Some pensions are set up so that usually you have options. You can get the highest number, which is my life only, and as long as I'm alive, it's paying the pension. As soon as I die, my pension's over, and my wife doesn't get it. Or I can select a lower dollar amount, which is more typical, and it will pay a stipend to my wife even after my death. So we hit retirement age. I make the selection that if I die, my spouse gets my pension, and with Social Security and pension and our 401k and all our other investments, she'll be set up just fine at 65. All of a sudden, boom, I need no insurance. There's an old adage that says if you're wealthy enough to retire, you're wealthy enough that you do not need life insurance, right? Because life insurance is to cover these shortfalls. It's not to make somebody incredibly rich, right? And certainly what I don't want to do is shortchange the amount of life insurance that I need so that my family's struggling. That's certainly, I don't want that. Also, I don't want to have so much life insurance that my family's awash in money for two reasons. One, if I'm overbuying life insurance, that means I'm spending a lot in premiums that I could spend elsewhere. We could go on vacations. I could work less. There's a lot of other things I could do. Plus, quite frankly, if I die, I don't want my wife having a whole ton of money and having way too much fun in life. Next thing I know, she's traveling Europe, she's got a 22-year-old boyfriend, going everywhere, right? We can't have that. My wife's supposed to stay home, dress in black, and suffer for 3 years at least, right? Until, I don't know, whatever that works. But there's kind of that magic number. We do not want to leave them short of money needed, but yet we don't want to spend so much money in premiums for money that they really don't need. Okay, also when we talk about life insurance, there's two basic types of life insurance companies. One is a stock life insurance company, which basically means it operates like a lot of other businesses. They have shareholders like Ford, like Bank America, right? They have investors within the company, and they operate the business. The other is called a mutual life insurance company, in which the company is actually owned by the policyholders. And so the difference between this would be a stock company would be like Bank America, and a mutual life insurance company would be like a credit union, right? At credit unions, the owners of the credit unions are the depositors. And so they're two different philosophies. Now, for the most part, you won't see any differences. All the laws and regulations, for the most part, are the same. And depending on which company you go with, prices might be very different. Just because it's a mutual life insurance company owned by the policyholders does not mean their premiums are going to be cheaper. In fact, a lot of times a well-run stock life insurance company will have lower premiums than a mutual life insurance company. On average, kind of like credit unions, mutual life insurance companies tend to have a little bit better customer service and very competitive rates. And so you tend to get better customer service, but premium differences, not nearly as much. There are lots of different types of life insurance policies that you can buy. The most common, and in my opinion by far the best, is term life insurance. Term life means you're going to buy life insurance for a specific term for 1 year. You pay your premium. If you die during that year, you win and you get all the money, right? Probably a game you really don't want to win. It works just like auto insurance. You pay your $100 a month or $1,000 every 6 months for auto insurance, and if you get in an accident during that time period, they pay it off. If you don't get in an accident, well, then the insurance company gets to keep that money, and they take that money and pay off all the accidents of all the other individuals. Whole life and group life type of insurance policies are kind of a hybrid between life insurance and a retirement savings account. So instead of spending maybe $1,000 a year in life insurance or $400 in life insurance, you're going to spend $2,000 a month in life insurance, and they're going to take a big part of that money and they're going to put it into a separate fund. So let's say that your life insurance costs $1,000 a year, and you want to set it up so you're saving another $500 a month for retirement. Well, your premiums will be set up at $6,000 a year. $1,000 will go to the life insurance part, what we call the death benefit. The other $5,000 goes into a separate fund that pays for retirement, kind of like a 401k or a 403b. Typically, the rates of return in whole life insurance and also universal life insurance are very bad. And so I couldn't recommend, in general, more strongly against whole life and universal life types of life insurance. You're much better off buying term life insurance, taking the difference and investing that in the S&P 500 index or the 401k through your work or a 403b. There are just much, much better options out there that will do it much less expensive. One of the other very expensive types of life insurance is what's called credit life insurance. Credit life insurance is you buy a car or you buy your house and you're sold a separate policy that says if you die during this time period, it'll pay off your car or it'll pay off your mortgage. While that sounds like a great idea, which quite frankly it is, conceptually it's a great idea, these types of policies tend to be very expensive. They tend to be situations in which they're not doing any credit checks, they're not doing any health checks, and a lot of people are just buying them as part of everything when they're doing it, and they check a box and they get sold this policy and they're spending a lot of money. You are much, much better off just going and buying term life insurance, where I might get $200,000 of credit life insurance to pay off my house, and then each year I'm making the same premium payment, but obviously my loan is going down to $190, $180, $170, $160. Odds are you can go into a term life policy for the same amount of money and maybe get $400,000 or $500,000 worth of coverage. The only area where credit life insurance makes sense is you buy a house or a car and you're sick. And you cannot get life insurance through any standard group. In fact, I was at Ford one time and we had someone come in and they bought 5 automobiles. And they took credit life insurance on every single automobile. And the individual had 5-year policies and was terminally ill and had 6 months to live. And we ended up paying off on all 5 of those because we didn't do any checks, and that just ended up being on us as Ford. Usually they'll get in situations where you have to check whether you know you have cancer or you know you have this, but when we got into this thing, the individual had been in remission. He felt a lot of pains come back. He hadn't gone to the doctor yet. He knew as soon as he went to the doctor he was going to be diagnosed with cancer, and so he stopped, bought 5 cars, then went to the doctor, then got diagnosed. So that's one of the reasons that those policies are so incredibly expensive. Some of the other factors here in term life insurance, one thing you want to make sure that the policy has, and unless it's an incredibly cheap policy, it's going to have a renewal term. A renewal term typically says that I've qualified for this life insurance, I don't have cancer, I've had my health screening, and I'm paying X number of dollars a year. And there'll be an adjustment as you get older, more likely you are to die, and so your policy goes up a little bit. But Renewable term means you can automatically renew. What you don't want to do is get in a situation where I sign up for this incredibly cheap life insurance policy, I'm diagnosed with cancer, and it goes over the ending period, because usually it takes 1 to 3, 4 years to actually pass away from cancer. And now I can't renew because part of the renewal is I have to recertify that I don't have cancer. All right? Most policies have renewals, almost all of them. Some ultra cheap ones don't, and so you just got to know that. I might want to buy what's called a multi-year level term. So instead of my rates going up and up and up and up a little bit, what I'll do is I'll pay a little bit more at the start, and I'll lock in a premium for 10 years or lock in a premium for 20 years. And although I've got an automatic renewal, now I know that for the next 10 years, here's the cost of my life insurance. And that is very advantageous for budgeting. In fact, most of the time, I've locked in either a 5-year or a 10-year level term pay just so I know that it fits in the budget. Probably less expensive for me to not go that route, to start off with a much lower premium and just pay a little bit more every year. But for me personally, I like the peace of mind. It's not worth the risk. Some of the other ones are a conversion term, which means you can take your term life and convert it to whole life, although most likely that's going to make no sense, so I recommend against that. The thing we call decreasing term insurance, this is a policy that I'm going to write that is going to pay off my house. And so I start off with a $200,000 coverage, and it reduces $10,000 each year for 10 years. So at the end of 10 years, I have $100,000 worth of coverage. Because my coverage goes down a little bit each year, I have less and less coverage. Instead of the policy costs going up a little bit each year, typically they're going to stay flat for the entire time period. The other type right now that's getting actually an awful lot of play is what's called return of premium. In my opinion, it's just a marketing game. You pay a little bit extra money. If you survive for the 10, 12 years, they will kick you back the amount of money you paid in premiums. And this becomes a time value of money question, right? Because you're going to give them extra money that they're going to then keep. That's going to ride forward, and you're going to get the money back at some future date. Well, maybe I pay $100 a month for my insurance now. I pay $200 a month for the return of premium coverage. If I take that extra $100 a month and invest it, how much will I have at the end? And so that gets to be a numbers game. The concept is fantastic and sounds great, but when you put in the numbers, it's not nearly as good of an investment. So now we actually need to buy a policy. So how do we go about doing this? Well, typically if you're going to buy a life insurance policy, your best place to start is who's covering you for your automobiles, who's covering you for your house. Because a lot of times you can get multi-policy discounts, and that ends up being the cheapest way to buy life insurance. There's an awful lot of companies online. You can go to AAA, Farmers, Fremont, AIG. There's just a number of them. And you want to call 5 or 6 or 7 different companies and get quotes. When I bought my last life insurance policy, I had quotes between $400 and $1,100. It is shocking, the difference. And they were both top-rated companies, both for the same coverage, both for the same exclusions, but one was going to charge me $400 a year, the other was going to charge me $1,100 a year. So obviously I went with the one that was $400. When you're comparing companies, one thing I strongly suggest is that if you don't know the name of that company and have never heard of them before, go to someone you trust who knows about insurance. Not necessarily the person who's selling you the insurance policy, right? You go to your aunt or your uncle that's in the finance industry or knows a lot about business, and you just ask them, hey, you know, I've heard about this company called AIG for my life insurance, but I've never heard of them. I mean, they don't sell auto insurance, so what's up with that? And I go, well, AIG is a huge insurance carrier. They do lots of businesses, lots in life insurance, and so I wouldn't worry about that being some no-name offshore company, right? We also want to look at the different policy features. So when we talk about policy features and also exclusions, all policies have exclusions. The more exclusions within the policy, in other words, the more ways they will not pay you if you die, the cheaper your life insurance goes. And so last policy I got an ultra low cost policy, and it's got a slew of exclusions. And it was a policy that was well over $1 million. And so I wanted it as cheap as possible. So some of the exclusions are, if I die jumping out of an airplane, parachuting, they won't pay. If I die scuba diving, they won't pay. In fact, if I die while I'm in the act of a felony, they won't pay. And so if you read that exclusion while you're in the act of a felony, most people think, well, I'm not going to rob a bank, so therefore that's not a big deal for me. But if you're drunk driving and there's great bodily harm, i.e. even yourself, right? I die while I'm drunk, they're not going to pay off. And so I have to know that. I went through all my exclusions. I do rock climbing with my daughter. And there was no exclusion in there for rock climbing. Therefore, if I die while I'm rock climbing, they will pay off. So you want to be able to read all those, because the last thing you want is to have a $600,000 insurance policy to pay for your kid's education and pay off your home mortgage, and there's a scuba diving exclusion in there, and then you turn around and you're on vacation in Hawaii or in Mexico, you go scuba diving and you die, you won't be covered. Okay, so that's the end of this chapter, and make sure to read all the details. Just like the health insurance chapter, there's an awful lot of minute details that are going to crop up in your quizzes. All right, thank you very much.